Wake up, it's time to rise. Talking money with sharp insight. Jim and Ryan here to guide. Mastering the money ride. Saving stacks and planning dreams. Living large by honest means. Tune in now for the schemes. Breaking down financial themes. Money mindset every day.
Well, I'd like to welcome everyone to the Money Mindset Mastery Podcast. I'm your host, Jim Leo. Joining me today, as always, is my co-host, Ryan Genoe. Ryan, how are things today?
Well, I missed the memo on the blue shirts today, so I'm rocking the green. Green is in money for the conversation that we're going to have today.
And Christmas theme as well, so you're in the Christmas mood for sure. Yeah. And joining us as well, we've had Denis a few times on our episode or on our podcast. So Denis Bisson, portfolio manager at TVH Wealth and Raintree Wealth Management. Denis, thanks for joining us. How are things today?
Things are going well. On this rainy day, I decided to work from home today for a change, and did well because just hasn't stopped raining.
Right. Yeah, we're getting actually freezing rain out my way. I was supposed to drive my daughter up to university to write her exam, but the university, for the first time in a long time, actually canceled all the exams this afternoon. So it's bad when they're canceling, and we're all nice and cozy. And today we're going to talk about a very cozy subject, the S&P 500. And I think really the reason why we want to have this conversation today for people who are listening and watching is recently, Ryan, Denis, and I, whenever we've sat down with a new client or existing client, we'd always get the question of, why aren't we putting all our money in the S&P 500? Look how well it's performed, and why should we be investing in a portfolio instead of an index where we would save money? And time again, what comes up is, yes, the last 10 years, probably, Denis, or so, the S&P 500 has performed really well. But we look at, a snapshot of time that we've taken. We're going to go through that today between the years of 1999 and 2010. So a good 11-year return. We're going to illustrate and talk about the performance over that 11-year period and the reason why you shouldn't put all your money into an index or a single index, and why a managed portfolio does make more sense. Anything to add to that, Denis?
No, I think that's true. Having been in the industry for over 30 years, I did live through some instances where markets did not perform well. And in the early 2000, 1999 and early 2000, after the dot-com meltdown and then you got 9/11, it seems like the negative markets would never end. And I'm not talking just small declines. They were fairly double-digit big declines.
So why don't we get started with maybe explaining what the S&P 500 is, Denis? So why don't you take it from there?
Well, the S&P 500 is the best representation of U.S. stocks and the stock market. The Dow Jones is only 30 stocks, so you can't use that one. The NASDAQ is a heavy tech influence, so that's not an appropriate index as well. The S&P 500 is the best index we could use to show you what how the market is performing. Over the years, of course, especially in the last few years, heavily influenced by the technology as well. And it's becoming a heavy weighting. As we know, if you want to call them the Magnificent Sevens, about that 35% weighting, which is a huge weighting. And I think those who were around in the early 2000s when you had Nortel became a huge weighting in the TSX. And it people were just concerned. It wasn't really a index you could judge the entire market on. It was an index that partially reflected how Nortel was doing. And we're getting the
Yeah,
same now with the technology stocks in the US.
yeah. I think I want to use that one as an example, the Nortel as an example, because I remember there were mutual funds that 20% of their holdings, 20 to 22% of their holdings, was all Nortel. Like it was just crazy, and that's why when Nortel and the dot-com era blew up, there was this massive decline in investment assets, specifically in mutual funds. And even back then, I would speak with clients and they would tell me how they were well diversified in their portfolios. And then we do the analysis of their 30 different mutual funds with 5 different companies. and their overall weighting was still about 20 to 22% in Nortel because they all had some Nortel in their mutual fund holding. Do you remember that?
Yeah, and they were over 20 because the book value remained under 10, which is the mutual fund guidelines. But if you don't sell it, the market value increased to that high, and some managers did not sell. It's one of those cases when you're riding the wave and you're doing well, you just don't want to get off. And you keep on buying it, thinking the same thing's going to happen next year. And it's a little bit being with our conversation today. We've seen strong returns. Are we expecting the same next year? What can drive next year's returns? This is the same thing with Nortel. And I've held Nortel personally. Probably sold it a lot later than I should have. And that was a lesson learned. That was the last time I did that. But at the same time, it was writing. And then you got to have to look at a certain point in time and say, am I expecting the same type of returns next year, in the following year, and make a decision on whether I should keep it or at least sell some off.
So, speaking about the S&P 500, it's been an index that's been around for quite a long time. Again, it is kind of like a benchmark index that a lot of people use. And for sure, since inception, had you just put your money into the S&P 500 and let it ride, you'd be fine. I think we've talked about that in other episodes as well in terms of index investments. If you're someone who can just kind of set it and forget it and not worry about what's happening, geopolitically, economically, like any of what you hear in the news, if you just leave it, you should be fine. However, even with the S&P 500, there have been periods of times where there has been no return to an investor. So right now, there's a lot of recency biases on the S&P 500. We're not saying you shouldn't have money in the S&P 500. That's not what we're saying here. What we're trying to do is really highlight that you shouldn't put most or all of your money, again, in a single index or one or two, because of the example we're going to show in a few minutes, where there was a period of time where you actually would have lost money, specifically if you're someone who was approaching retirement. So I'd say 5 or 10 years away from retirement or was in retirement. And this speaks to the whole sequence of return risk that we talk about and why you have to kind of prepare for bad market cycles. And the problem, I think, is, Denis and Ryan, you guys both know this, it's difficult to anticipate when we're dealing or approaching a bad market cycle. You find out about it once you're in it or in hindsight looking back, right?
Yeah. And don't forget, when you're looking at returns, short and longer term, after 2 or 3 years of good returns, they're all going to look great. You get 2 or 3 years of bad returns, all those numbers will start to look less great as well. If you're looking at 5 and 10 years off, since inception, or 30, 40 years, it becomes irrelevant. But if you're looking back that 10, 15 years, they all look good after a couple strong years in a row. And that's when people may think, oh, look at that. Look at that nice 10-year return. Maybe I should keep it in there, without realizing that could quickly change.
And in terms of the recent performance of the S&P 500, because again, we're hearing a lot of this, we're being questioned on this quite frequently, rightfully so. Has it been a strong performing index over the last, let's say, 5 years?
It has. We only had that hiccup we had in, 2021? Or pardon me, let me just double check. 2022. 2021 was a nice bounce back. 2022 was not good. You had down over 20%. And there was different themes that were driving it. Of course, a couple of years back, we had the FANG stocks. And now we have the Magnificent Seven, really, which is really the only difference. Netflix got taken out, and you got Tesla and Microsoft that got added. But meanwhile, Netflix is up over 80% this year, so I'm not sure they should have been taken out. And Microsoft is up under 20. But it is a theme. When you're looking at NVIDIA, that's becoming that I believe is now the largest company, is up over 180%. Now, when you got a larger weighting and it's up that much, it's going to take over and the overall returns. It's going to be heavily influencing the overall returns without the breadth of the market, which is all 500 stocks going up at once. You're getting really driven by those 7, 8, 9 stocks as opposed to the breadth. When the breadth increases, and we're hoping to see that, we're starting to see a little bit of the small and mid caps come to life. If those start, then you're going to start seeing more companies doing well, and that's going to be good for the market. A lot of positive deregulation with the change in government in the U.S. We'll see what happens because you also get potential tariffs there at the same time and see how that affects companies. Um, but this is a case where you really have to and look at your returns because a lot of big brokers in the U.S. have not have very strong outlook for the U.S. over the next 10 years. Whether that comes true or not, and I think we mentioned this before in some other podcasts, we're not sure, but you do have to reevaluate really every year. Can I have some of my money somewhere else? First of all, to diversify, to reduce that risk. The easiest way to diversify is not being invested all in one place. Keeping that in mind, that we know now the MSCI world, the weighting of the US is over 65%. So the US market is much stronger than all the markets, especially Europe. Europe, I think, was up about 5-6% so far this year, depending on which benchmark you're looking at, versus over 20 for the US and 20 in Canada as well. So that's going to drive the weight even more so on some of these indices that you're buying. So now if you buy the MSCI World, you're going to have a heavy US presence. And you're going to have to, should you rethink that because you're going to be 65% plus in the US? Or buy a combination of indices for a portfolio, or just get a natural portfolio to diversify. So buying in other areas, some areas that did not do so well last year may do well this year, or some of them that are just picking up with reasonable returns. That's what you should be looking at as opposed to the entire S&P 500.
Well, let's show the visual. So I'm going to share this and then discuss what this is. So once again, I'm hoping technology is on our friend today. Hey, it's our friend today. Just have to make a little amount of adjustment. So what we did here was we pulled up an example of an investor investing $500,000 in the S&P 500 in 1999. So someone in 1999, again, Denis, when you make comments of certain people are kind of projecting maybe issues in the markets over the next 10 years, I don't know if anyone in 1999 looked at the S&P 500 and thought that this was going to be the result 11 years later, right? So to show you here, basically, if someone put in $500,000 in the S&P 500 in 1999, see if I can show this here. You should be able to see my mouse.
Yep, we see it.
Now, look what happened. Within 2 years, 3 years actually, there was a 40% drop in value, right? So your 500,000, this is without taking any money out. This is we're just looking at market value of the portfolio. So 3 years later, by the end of 2002, your $500,000 portfolio is worth $300,000. Now, can you imagine? And again, this speaks to sequence of return risk. We use an example of the S&P 500 from 1973 to, I believe it was 1994. Over that that period of time, someone who was drawing money out of their portfolio actually would have run out of money, even though the average rate of return of the S&P 500 over that period of time was about almost 13% per year. Okay, so right now we're showing another example of the S&P 500 now from 1999 not taking any money, because if you were drawing money, so let's say you were taking off 5%, so $25,000 a year. Well, in year one it's $25,000, but if you were needing $25,000 a year, this would have accelerated the losses, right? And a big reason for that, Denis, that was the dot-com bubble that blew up, right? That's what caused it. And then in 2000 oh, go ahead.
No, I was going to say, if you remember that time, everybody was thinking this is a bubble. This is a bubble. We should sell. We should sell and start, doing other things. Well, nobody was really selling until everybody started selling at once. And that's when the bubble burst. Now, if you look at what's going on today with AI, is that going to happen? No one knows. But they will sooner or later start looking at profits. The profits continue, then you may see this continue. This, what happened in the early 2000, as you were going to the 2001, you had 9/11, and it was just nonstop bad news that was really hitting the markets. So you had 9/11. Of course, after 9/11, you had the war in Afghanistan. Shortly after that, as you're barely getting a hold of that, markets started going up again, and then you get Iraq. That affected obviously more U.S. than anybody else. So you get some 1 year that was only 3% return. So the double-digit 20% returns were not there. So it was a tough time to be in the market, a little bit tough time to be invested, but you really had to diversify. You look at what's going on in the Canadian market, you look at the European market during these periods, but it's just there wasn't that much positive in the U.S.
And again, looking at trying to predict what's going to happen from today moving forward, this is an example, because I remember in 1999, yes, there were some people calling a bubble. Most people didn't. They kept on investing. I don't think anyone expected 9/11 to happen, right? And that had an impact. I don't think anyone expected the war in Iraq to happen. Like, there were a lot of these geopolitical events as well that took place that impacted the markets. So moving forward, it's the same thing. I mean, who would have thought in 2000 that at some point BlackBerry wouldn't be the BlackBerry of today, right? Like, BlackBerry, Nokia was another big name back then. There were a lot of big names, Nortel, that are just not really big any longer, right?
Mm-hmm.
So that's
Oh, yeah.
why this is why I caution people to diversify, as you mentioned. Why we're highlighting why people should be in some sort of managed portfolio solution. So
Yeah, and if you're looking at today's market, when you're comparing to that, it's I wouldn't say it's going straight up, but we've hit what was it, about 55 new highs so far this year in the S&P 500. That's almost straight up. The one thing that anybody knows who's been around in the market for a while, nothing goes straight up
no,
forever.
no.
So that's why you have to be careful. Is anybody predicting a complete meltdown? No, and even the brokerages that are not predicting big returns aren't predicting any type of big sell-off or meltdown. So it's one of those cases where, again, review, analyze what's the expectations. Can NVIDIA go up, another 200% next year? Not likely. They don't have the capacity. They're still manufacturing and everything else. So you do have to look at what's next outside Bitcoin. That's going
So,
crazy now.
that might be another episode we
Another
record.
story, yes.
Yeah. So now look at 2002. So down 40%, and it took 5 years to break even. So total actually took 7 years, 8 years to break even from the original investment. So if you were invested $500,000 in 1999, didn't take any money out, you would have broken even 7 years later to bring your portfolio back up to $500,000. Now, again, for someone who is investing at age 25, dealing with this, that's okay, because there still is a whole lot of time in terms of recovery. When you're someone who's 5 years away, 10 years away from retirement, and this happens, this is a problem. This is a big problem, especially when you start drawing money out. So the person 8 years later, they're like, finally, I broke even. Now I can start making some money on my portfolio in the S&P 500. And then 2008 happened. And in 2008 alone, they lost almost 40% just over that 12-month period, right? So literally you're right there. And again, this speaks to trying to time the market. I'm sure many people didn't think after 8 years of breaking even that, okay, now let's just get out of here. Bad investment. Let's go somewhere else. Many of them probably sat thinking, all right, finally, we waited it out. We're okay. And then, boom, they lose another 40%, call it, right? And then 2 years after that, so to 2010, there was a bounce back. But if you look at this example from 1999 to the end of 2010, $500,000 would have been still worth $425,000 after 11 years. Denis, is this a good investment?
This could only be a good investment. First of all, it's a little difficult to discuss. This is not a good investment if you're looking at it now. If you're looking at it in that 10 years, then maybe a good investment, but only a good investment if you're buying throughout. And believe me, nobody was doing that. If you're just watching it fall and waiting for it to go back up, that's not investing. That's just crossing your fingers. It's almost like buying a gold mine and hopefully they finally hit something and you never touch it. It's buying because anytime you're investing on a regular basis. That's the only way your portfolio is going to go up. It's going to go up the market. It's going to go up with new investments, and knowing those new investments will gain as well. So this would not be a good investment because 2011 the market did absolutely nothing. So you could add one more year to that, uh, and at the same time, uh, nobody really has the how would you put the fact to stay put. No matter what you thought before, when you actually living it and looking at your portfolio all the time, you're seeing that. No, you're not going to be adding. Very few people added new money. You may add money to a full portfolio where some of it may be going to the U.S. And don't forget, you can't ignore the U.S. If they're going to be a 65, 67% weighting now of all markets in the world, you're not going to ignore them. So you want your position there. My only comment on this is yes, you maybe want some of it in there. You certainly don't want all of it.
Well, this speaks to behavioral economics, right? Because the bottom line is this: when you deal with, and I'm going to, you know, go after some of the robo advisors who say just put your money in indexes, whatever else, because they assume that people will act rationally under all conditions. That's the problem, though. Most people do not act rationally. So when you see someone who's about to retire and their $500,000 drops down even $50,000, they're not acting rationally. They're panicking, right? Um, and on the flip side, when the markets are down at the bottom, at the low end, people are not thinking rationally. You might have some that see it as an opportunity and say, you know what? We're down 40%. This has got to be pretty close to the bottom. So maybe we should start investing now, not necessarily knowing that they're at the bottom, but pretty much close to it. But most people don't react rationally. And this is the reason why, when we talk about passive versus active, we believe in the active investment strategy, diversifying, to your point, today. And you can talk a little bit more about the portfolios at some point. But this is why we believe in active management and diversifying in multiple asset classes, because these are the situations you can't predict. You can never really anticipate when it's going to happen. And no one is going to, or most people are not going to act rationally during these extreme conditions. Is that fair to say?
Yeah. Yeah, and we had when I worked at the asset management, we had a lot of U.S. contacts, pardon me, during this time. They were actually in quite of a panic during 2008. They saw some of their stocks, even our own stock at the time, bank stock, went down 30+%. There was a lot of panic out there in the markets and with people and investors. So you got to remember that part. In diversifying, as I mentioned, with small caps and mid caps may take their turn this time. You don't have to be the S&P 500 for that. You could be in the U.S., but in a different part of the U.S. market. And that's what we do a little on the portfolio management side is we do invest, of course, in the S&P 500, those type of stocks, but also in a separate sleeve of the portfolio in the small caps. And is it their turn? That may be the place to be as opposed to somewhere else. Because when you're in the moment, you're back to your behavioral comment. Not everybody will just stay the course and either buy more when it's down 10, 20, 30%. During the 2008, I bought more when it was down 20%. Watch that go down. Did I buy more? Nope. Watch that go down. And then finally it jumped back up and I made some money after it went down 20%. But, I even hesitated to invest more when it was going down, even after I put in some new buys. So It's you can't predict how you're going to react and how the market's going to react and the people around you.
No, I mean, I remember that period of time because I think the economists changed their predictions like 26 times over a 6 week period. They didn't really know. Back then, I think Amazon was new, but I don't think they were still selling the crystal balls back then. So it was very difficult for them to really anticipate what was going to happen. But most of my clients, many were panicking. They were nervous. My job was to communicate with them on what our strategy was, and my strategy was simple: do nothing. We just hold. We ride it out. We're in a storm. We ride the storm, and that's what actually I would say 99% of the clients did. Was they're like, okay, we're just going to ride it out and do whatever. I actually had some clients because I did say to them, this is a great buying opportunity. We don't know when we've hit rock bottom, but these are some, extreme declines. I actually had people leveraging into the market during that period of time. That's like crazy, right? I mean, a lot of people thought this is nuts. Like, why would you leverage during that period of time? Well, guess what? 5 years later, those people essentially double their money, right? And it's not like we picked a date and we said, this is the absolute bottom. It's just we figured, hey, 40%, that's significant. Could it drop another 40? Absolutely. That was part of the risk, right? But it worked out for them. I remember having
Yeah,
conversations with clients calling me because they had money on deposit with different banks, and they wanted me to move it out of some of the banks and deposit it elsewhere because they were afraid that the banks were going to fail here in Canada. And I remember asking some of these clients, like, do you really believe that TD Bank, for example, is going to fail or Royal Bank is going to fail? And the response was, they're failing in Ireland, they're failing in the US, they're failing why won't they fail here, right? Fundamentally, there were reasons why that they wouldn't fail, and they didn't fail in Canada. But the reality of it was is people were bombarded with all this information. A lot of it was fear, the unknown, and they were retreating. People do not act rationally during these extreme situations. This is why I repeat why we need to be looking at active portfolio management as opposed to the passive, because the passive portfolio investors, again, a small percentage that will ride the wave, will ride the storm. Most people won't. They will get out at the wrong time, get back in.
yep, and yeah, and 20 when the banks go down 20-30%, there has to be some thought maybe they will fail as well. There were some big names that failed in the U.S., and then they had mergers after that, and we were getting letters from our clients saying they accepted. I think it was called the TARP loans, and there they had to tell other clients that they took on some of the loans, some big names too. So you never know what goes on in that, and that's why. And that was a sort of I wouldn't say a lesson learned for me, but I learned from that. I also leveraged in the COVID sell off, and made a good return, paid off the loan, took the return, and because I knew it was just panic selling. There was nothing was known yet, and they were just selling. I had maybe one or two clients only panic that I could not talk out of selling that went to cash. But when it's panic for no reason, where you can't see earnings or the economy slowing or anything like that, that's going to affect earnings for a longer period, and you're just selling. That's when it's time for maybe more experience or people a little more able to take the risk to start investing.
I
And
like
again,
that you
not in
said
the
that.
same place.
Yeah, I like that you said that 2008 as an example was a learning opportunity or experience for you, because it was for me as well. And that's where some of my mindset shifted in making a lot of my recommendations for clients. And I think this stresses the point again: you need to work with experienced people, right? I would rather be on a ship with a captain that's been on the seas for 30 years and has experienced all kinds of different situations than to be in the same ship on the same trip with someone who's only been doing it for 2 years and hasn't experienced the same level of storms and whatever else, right? So this is where I really want to focus on working with people who have experience. We've experienced these things. We've gone through the Nortel bubble. We've gone through the BRIAC situation. We've gone through, again, the various wars. Like now I hear people going, oh, war. What's that going to do to the markets? And this is different. We've had wars before. This isn't different. It might be a different war. Maybe it might be even a different country. But it's the same. We've experienced with it. It's unfortunate, right? But when we're dealing with money, there's ways that we have to approach it. And I think it's kind of like the analogy we use about, going out sailing. And I keep talking about ships and sailing. I'm not even a water guy, but anyways, I'll use the analogy where, when you're on a sailboat, you can't control the wind, right? All you can control is how you set your sail. That's it. Right. So we can't worry about all these other things that are happening out there. We're mindful of it, and we definitely have our ear on it, and we want to have an understanding of what's happening. But all we can really control as advisors is how we set the sail, how we invest your money, how we react to those situations. That's really the bottom line. Right. Do you have any questions for
as
Denis?
somebody who worked on,
You're
not really
a
questions,
boat
but
guy.
just to add, I'm a boat guy. I worked on a ship, right? And one of the more important things was about risk management, right? And how do people react during the bad times and the good times? And man, oh man, in the seas. I hit some really bad waves, and the people who remained calm were the ones who wrote it out, right? And if you surround yourself by a group of people that are hysterical about it and worried, and you don't have the right ship captain, you don't have the right people around you, then things can get kind of ugly quick. And it'd be very interesting, Denis, for those people that decided not to follow, your direction and advice. Who were the people that were on their boat, on their ship, that were potentially giving them bad information and were potentially hysterical during that time to say, hey, let's look at historically, let's look at the person I'm taking the advice from versus my neighbor who only talks about the good times and doesn't talk about how they got through the rough seas. And I will stop referencing ship things now, but I think in the end it's figuring out what your objective is financially and how you're going to get there. To beat a dead horse, which is making sure you truly understand, and like we truly understand what diversification actually means versus what a banking institution is going to tell you about what diversification is, because the S&P 500 following the 500 best companies at that time, forever changing. Look at how you're involved in your market and your investments when you dig deep into what each advisor that is currently advising you is giving you that advice. And again, we've said it a few times through here, is making sure that you truly understand what diversification is, and that your sequence of return risk, again, a huge eye opener for me over the last 5 or 6 years that a lot of people just aren't talking about. And that's why we're talking about it, is so people think differently. So
The bank's not going to talk about sequence of return risk. The bank's going to diversify you into their investment products. So you might not really be fully diversified. You might not be necessarily in the best products. We've been debating on doing an episode on a recent article about the banks and their practices, and how there's now an investigation that's going to be launched into bank sales practices, because they're finding that many of the recommendations are not made with the best interest of the client, but it's more because of the sales practices. And I'm not blaming the employees at the bank level. This is direction from up top, right? So I don't want people to think that bankers, employees are bad people. They're not bad people. They're just basically doing what they're instructed from the top. And if they don't, guess what? They're out of a job, right? So we might talk about that, but I want to stick to this topic and wind it down soon. But Denis, let's talk a little bit about then how an active, well diversified portfolio can protect someone over during a period like 1999 to 2010. with the S&P 500? Like, what would be the benefit of having it been invested in an active portfolio compared to fully invested in an index or two?
Well, way back in the back in the late '90s and early 2000, alternatives were not really available. You didn't hear too many people talk about them. Private credit, private equity, um, absolute return funds. You didn't really hear them talk about it, or it was only for a specific set of people. Now it's more wide open. It's to help with diversification. The S&P 500 is, I don't think, can ever be ignored, and you probably always should have at least some exposure to it. But at the same time, you don't need to have all your eggs in one basket. There's other parts of the US market you could go into that I mentioned before. There are other markets, whether it's emerging markets, Europe, again, the alternatives. Never ignore the Canadian since we're Canadian. But you're not going to put 20% in there either. So it's a matter, and you get in some cases, even the growth investor may want to go maybe into some fixed income. Not much, but maybe some fixed income as well, depending on the expectations for the other asset categories. So it's a matter of looking a little at everything and coming up with a well diversified portfolio based on your risk level. The one thing we don't want, if the market corrects, the portfolio will go down. If you're more aggressive, it'll go down a little more. If you're less aggressive, obviously less. And depending on how much you have on the alternatives and how that's doing, you don't want anybody who loses sleep. Everybody is an aggressive investor when they're getting high returns. Oh, they'll take them and they won't say a word. Even my conservative investors are going to get double-digit returns this year, and they're not going to say a word. They won't ask me if I took extra risk. They won't ask, even though we did not. It's just that's the way the portfolio worked this year. But when the market goes down, that's when you'll start getting the questions. Am I invested too aggressive? Even if it's down a little bit, especially when you're treated and you're seeing on the news that the markets are hitting new highs. Like I said, over 55 new highs in the S&P 500. You want to see some of that return on your own portfolio as well, without realizing if you were all in there, the risk that it takes. And nobody knows if this is going to be another bubble. And I know some people saying it's different this time, but we don't know that. I can't
It's
say it
always
is. I
different.
can't say it isn't.
Yeah. Yeah.
Yeah. And we're not going to make predictions on that. We just want to make sure if it does correct, that your exposure is not too high on it. And if it doesn't correct, you want to make sure you're getting some of those gains as well. It's a combination of the two in managing risk and diversifying.
Yeah, it's amazing. And maybe if you're someone who's listening here and wants to make a comment, we welcome you. We welcome you to comment on our different social media platforms. You can make a comment on our YouTube channel as well. You can even email us. But I remember there have been times where I've moved clients out of their robo-advisor platforms, which is all index-based, and a lot of them very aggressive, and I moved them into the Raintree portfolio. And 2 years ago, I think those clients were negative 4% in their Raintree portfolio. And they were losing sleep over losing 4%. And then I would remind them, I said, had you left your money in the robo platform, you'd be down like 15% right now. So, yeah, we're down 4 and we're going to recover a lot quicker. But it would have been a lot worse off had you kept your money where it was. And I'm just curious how they would have reacted had they left their money in those robo platforms, right? If they would have redeemed sooner, would they have held on? Would they have invested? I mean, the bottom line is there would have been no one to give them any guidance, right? They couldn't have called any of those platforms and say, hey, what should I do right now? They would have received no advice whatsoever. At least with us, we were able to illustrate, well, yeah, 4%, you hold on, here's what it could have been, here's what the index are doing. Relatively speaking, we're doing really, really well, which means recovery is going to be a lot quicker, potentially, right? Because we're not dealing with a deep loss, but we walk people through those situations, right? You're not going to get that investing in indexes. You're not going to get that in, working with a robo-advisor platform. You're just simply not, right? And yet they're assuming that their investors are going to react rationally to those situations, right? So, so I think, guys,
Yeah,
I
and
think
don't
we've
forget a
been
portfolio
beating a.
manager.
Oh,
Sorry, I just
go
wanted
ahead,
to add
Denis.
one last comment.
Yep.
I, I was just going to say, don't forget a portfolio management platform. They will change the weightings if something's going on, if something big news that's going to affect markets, like a war, whether it be Afghanistan. Ukraine sort of limited the who's going to be hurt, especially in North America. Of course, Europe was hit a little harder when it came to natural gas and everything else. But the robo advisors will not make changes to your weightings. They will not all of a sudden say you shouldn't be 40% US, given what's going on, maybe bring that down to 20. No, they will not. They'll just keep on rebalancing to the same weights.
Yeah. No, I agree. I agree. Ryan, any final comments, thoughts you want to make before we shut down?
I think a lot of it has to do with your behaviors and the habits that are created. And when you have a negative experience with working with the robo advisor or really terrible advisor, you're working with a team here at TVH Group, and you're working with TVH Financial, TVH Wealth. So you're getting a lot of information and education along the way that we provide. And I think no matter what your investment strategy is, there's different things to consider. Obviously, if you're nearing retirement, talking to me about understanding if it's a wise move to be involved in the S&P 500. If you're just looking to follow the trends of everybody else and finding the balance between risk and reward, talk to us and find out what's best suited for you and your financial goals. And I think more often, if you haven't talked to your advisor, call us and have that conversation dialogue. Help us understand what your risk to reward is and what your ultimate financial goal is. And already our clients will see the difference that we're providing for them is really added value from the TVH group as a whole, to really make sure that all areas of your financial goals are being met, no matter whether it's looking for a new place or an investment, making sure that your will's set out. All these things are all parts that we have involvement in when helping somebody create an actual full plan. So just things I want people to consider who are listening. So
Yeah, and I'm just going to do a little plug here. I'm going to share my screen. If you want to actually learn more about the psychology of money and how um, you need to be thinking when it comes to investing and your money and your finances, I encourage people to go to our website, tvhfinancial.ca. Here you can download our complimentary ebook, Mastering Personal Finance, The Psychology of Money, and the Tortoise versus Hare Strategy. It's not a long read. It does a really good job of kind of breaking down how you should react to certain situations, different personality types when it comes to money, and why most people should be considering an active portfolio solution as opposed to passive because of what you'll read in the ebook as well. So I just wanted to um, plug our ebook there as well. Any final comments or thoughts before we shut it down?
No, I think I got most of my comments in. Think, diversify, and manage risk.
Okay. So basically, I'm going to just show here as well, TVH Wealth. So while this is loading, if people are looking or want to find out more about your portfolio solutions, they can go to tvhwealth.ca and find out more about Denis, the team, the construction of the portfolio as well. Sign up for the e-newsletter. And again, you can find out a little bit more about Denis there. And going back to us guys, if you're looking for some information about TVH Financial, we're just going to show you here, handsome dudes, once it loads. So you can find out more about Ryan and myself as well and how we can potentially help. And yeah, I think that's it. And obviously, guys, they can go to all the various social media platforms. So the YouTube channel, podcast, Twitter, Facebook, LinkedIn, Instagram, TikTok, all those places. So I think we have another one in the books. For sure, we're going to have one more episode next week, Ryan, before the holiday break, correct?
That's correct. Yeah.
Yeah. And that's going to be about, um, uh, remind me again, what's that episode for?
We're interviewing and meeting somebody who coaches kids. So I
Life
know we've
coach.
talked a
Life
lot about
coach, that's what
financial
it is.
literacy and how to overcome different habits. And it'll be interesting I'm really excited to interview with them. So
Yeah, so Patty Pinozo, life coach for the children. So looking forward to that. And we might sneak in one more episode. I think we might have to talk about that one about the investigation into the bank's sales practices. So that might be a final Christmas gift for the banks. So that might be one more episode that we'll do. But anyways, thank you guys for your time. Once again, if you have any questions, reach out to us. And obviously, you can also email us financial@tvhgroup.ca. Thanks, everyone. Have a wonderful afternoon. Take care.
Why is it me? Why